Everyone points at the size of the Fed's balance sheet, but almost nobody can say what's actually on it. It's just a ledger with two sides, what the Fed owns and how it pays for it. The Fed's balance sheet gets blamed for everything. But here's the funny part. Most people who fear it can't actually say what's on it. So what is it really? And why do markets read every line? The headline says a big balance sheet means easy money, and a small one means pain. And that's where everyone oversimplifies. So let's slow down. The reportable, boring truth is that a balance sheet is just a ledger with two sides. On one side, the assets, what the central bank owns. On the other, the liabilities, how it paid for them. We're not going to call any market, predict a yield, or forecast your portfolio. Instead, let's actually read the two sides, because the secret isn't how big the sheet is. It's what's inside it, and how the inside shifts, even when the total barely moves. Start with the side everyone forgets, the assets. When the Fed buys securities in the open market, those securities land on its books as things it owns. And the mix is simpler than you'd think. Overwhelmingly US Treasury bonds, plus a big stack of agency mortgage-backed securities. Bundles of home loans, MBS for short. That's basically it. Picture two tall bars stacked up, a large Treasuries bar and a smaller MBS bar. This is the pattern across eras. It began at scale after the 2008 financial crisis, and then exploded in the 2020 pandemic, when the balance sheet swelled towards something like $9 trillion by 2022. And those figures are illustrative, just to show the direction. The point isn't the exact number. The point is what these assets are, safe bonds the Fed bought and now holds. So far, so ordinary. It's a giant bond portfolio. The interesting question is the one nobody asks. Where did the money to buy all of that come from? Here's the part that surprises people, and it's the whole trick of central banking. When the Fed buys a bond, it doesn't dip into a vault of saved up cash. It pays by simply crediting the seller's bank with new reserves, money it creates with a keystroke. Those reserves are a liability. The Fed owes them. So every asset on the left is funded by a liability on the right. Read the liability side and you'll see four big buckets. Bank reserves, physical currency in your wallet, the Treasury's own checking account at the Fed, the TGA, and the reverse repo facility, the RRP, where money funds park spare cash overnight. The iron rule underneath all of it is one line of accounting. Assets equal liabilities plus a sliver of capital. Buy an asset, create a liability. That's not magic. It's just a ledger that has to balance. Now, the payoff. Why traders watch this ledger like a hawk. And here's the myth worth killing first. The popular story says the balance sheet is just money printing that must ignite inflation, so a big number is automatically scary. But that misreads the ledger completely. Those reserves sit locked inside the banking system as the Fed's own liability. They are not cash handed to people to spend. So, the size alone tells you far less than the headline implies. The real action is on the liability side, in the mix. Money can slosh between those buckets even when the total doesn't budge. When the Treasury rebuilds its checking account, the TGA, it pulls cash out of the system. And bank reserves fall even though the balance sheet is flat. When the reverse repo buffer empties, that cash flows back into reserves. And reserves are what actually matters, because they're the fuel the banking system runs on. The proof is history. Back in September 2019, the balance sheet was nowhere near a record. Yet reserves got scarce, and overnight funding markets briefly spiked. Same kind of sheet, completely different liquidity, depending on how the inside is arranged. That's why the composition, not the headline number, is the part worth tracking. Before you treat this as a crystal ball, hold all of it loosely, because a ledger describes, it doesn't predict. First, the figures move constantly. The exact size, the split between Treasuries and MBS, the level of reserves, all of it shifts week to week, so any number here is just illustrative of the shape. Second, size alone tells you very little without the composition next to it, which is the whole point we just made. And third, the Fed isn't flying blind. Its stated aim is to keep reserves at a level it calls ample, and it adjusts to get there. So the ledger is a lens for understanding what the Fed owns and how it's funded, not a signal about where any market goes next. Read it to understand the plumbing, not to time anything. So, here's the takeaway. Go back to where we started. Everyone names the Fed's balance sheet, but almost nobody can read it. Now you can. It's a two-sided ledger. On the left, the assets, mostly Treasuries and mortgage bonds the Fed bought. On the right, the liabilities that funded them. Bank reserves it created, plus currency, the Treasury's account, and the reverse repo buffer. They balance by the oldest rule in accounting. And the part that actually moves markets isn't the headline size, it's how the inside is arranged, because reserves can rise or fall while the total sits still. But hold it loosely. It's a description of the plumbing, not a forecast, and none of this is advice. So what should you actually read? Not just how big it is, what's inside it. Don't just watch how big it is, watch what's inside it.